Hello. Welcome. Thank you for joining us. Martin and Chelsea Matthews here, and welcome to our live event, Build Your Own Bank. How to build your own bank so that you can build more wealth, you can keep more wealth, and you can make sure that it lasts so you can enjoy it. Right?
So you can do it without being too old and decrepit to enjoy. You don't want to be old and decrepit and got all the money, but you can't even, you got no way to enjoy it, right?
So as you're coming in, please join us. Let us know where you're coming from. And if you know anyone that may want to join us for this event, there is still time. You can tag them. You could share this out. We would love to share this information with as many people that can use it and apply it. So please let us know where you're coming in from, share it out, invite anyone, tag them. And we'll get started in just a minute here, but as we go along, if you have any questions along the way, feel free to write them in the chat. We'll do our best to answer them live today during our event. And if for any reason we don't get to your question, we'll make sure that we reach out to you and we get that question answered. Yes, and we have a free gift for you today. So make sure that you stay till the end of the event and we'll show you how you can get your free gift for joining us in this event. Joy, that is a really pretty picture, the flower. That's a really pretty picture.
So shout out to a few people on here. What's up, Joy Carroll, DC. Taylor from Mayor, Alabama. I know you guys are here in Georgia right now. David Baines. Cool. Big shout out to you guys, 10X family. Appreciate all you guys for watching. We're streaming on multiple platforms. We're on YouTube, Instagram, Facebook, all that. So if you're looking at different cameras, that's what's happening. We're going to be screen sharing some of our stuff, the information that we got for you guys, mostly on YouTube and Facebook. But you guys can still hear us on your Hustle Spirit 88 from Miami.
So we have a gift for you at the end, and we will also share with you how you can get more, how you can apply some of these tools and strategies that we're going to share with you today in your own financial house. And the reason that we're sharing this information, the reason that we're doing this event is because this information has truly changed our life and our business. And so we want to make sure that we share this out because we didn't always know this information. It took a long time, a lot of work, a lot of mistakes to learn and apply this information. And there's only a small percentage of people in America actually using this information, knowing about it and applying it in their financial house. So we want to give you a head start. We want to share this information so that you can apply it and not take all the time it took for us to learn and apply it. Because we work together. I'll tell you a little bit more in a minute about, if you don't already know who we are, why we're qualified to share this information with you. But we didn't always know this information. We weren't always on the same page financially. We didn't always have a business helping people strengthen their financial house. In fact, before I met Martin, I was a single mom for 7 years, and I struggled to find a balance between financial success and family success. And I felt like I was either spending time with my son and broke, or I was making money and not spending any time with my son. And that was not the example I wanted to teach him. That was not the life I wanted to create. And I knew there had to be a better way. And so I knew there was some information I was missing, because if I knew that better way, I'd be living it. So I set out on a journey because I figured if I could learn a better way, I could teach my son and I could teach other parents as well and make a difference. So I set out on this journey. I read books, I went to seminars, and I searched for how money really works. And I eventually met this group of financial advisors. They were teaching people how money works. They were making money doing it. And I thought, yes, this is what I need. This is what I want to increase, the quality of my life, my son's life, and be able to help other people to do the same thing and make money. And sure enough, as I was working with these people, Martin was also working with this group of people. That's how we met and we connected. And he kind of took me under his wing, showed me the ropes because he was already doing some of this business. And what we learned is that as we got to know each other more and learned about our goals and impact that we wanted to make in our life, we realized we were so aligned in the kind of life we wanted to create that we decided to combine our business and combine our life. And now we're married, we're parents, we're business owners, and now we get to help people like you to strengthen your financial house and reach your financial goals while working on that on our own as well.
Absolutely.
So we'll get started with our event. Is there anything that you wanted to say? Okay, so let's get started. How to build an unbreakable finances in your household and business. Like I said, we're Martin and Chelsea Matthews, and this screen right here, knowledge, responsibility, and control. This is how we actually share our information. We don't tell you, hey, we're experts, we're geniuses, we know what we're doing, and you just have to do what we say. No, this is where people get in a lot of trouble when it comes to making financial decisions. They do something because they heard it worked for somebody else or some expert guru told them to do it, but they don't actually know why. So our whole goal is to help you increase your knowledge so you actually have the information that you need to be able to take more responsibility for your actions, your decisions, because if you know something is right for you, then you could take the responsibility for making that decision because you know you have the right information to make the right decisions. And then when you do that, you have more control over your life, your finances, your results. And I definitely want more control in my life. I definitely want to be in control of my finances rather than it controlling me. That's when you get to say yes to more things and you don't have to say no to things because your money is in control of you. So we want to help you increase your knowledge, responsibility, and control. I guess I could switch my own slides, right?
Yeah.
Oh, okay, and I already told you guys this. Yes. So knowledge, responsibility, and control. Okay, so if you don't already know who we are, we're Martin and Chelsea Matthews. We're founders of M Wealth Group. Now this slide says we have clients in 46 states, but now it's actually 48 states. We have a combined 19 years experience. We started when we were 12. Just kidding, we just look very young. And we lead agency of associate advisors. We also have held multiple licenses in the field of investment advisory, securities, and insurance. So we're not just financial coaches. We are actually licensed and trained and qualified to be able to share this information and help you put these things into place. We're also co-authors of the book, Let's Fight About Money. Can they see? Okay, you guys can see let me put it up here close. So Let's Fight About Money, helping couples communicate about money, handle conflict,
share it on Instagram too,
and build an unbreakable financial house. And should I tell them?
Yeah, you can.
Yes, so the gift today for you guys for joining us, we're going to give you a free digital copy of our book, Let's Fight About Money. So make sure to stay till the end and we'll show you how you can get that. And this book, we share a lot of personal stories about making financial decisions together, parenting, strengthening your financial house. Key. Whether you're in a relationship or you just talk to people, communicate with people, make financial decisions with people. Oh yeah, I keep forgetting that I gotta work so hard switching my own slides. Okay, so we help individuals and businesses properly use cash flow to create personal wealth. Our mission is to deliver measurable results to help our clients build an unbreakable financial house and business so they can be free to live life by design. Doesn't that sound nice? To be able to design your life, not just react to life as it happens. Okay, so I mentioned a couple times I talked about an unbreakable financial house. And what that means, let me go back to this really quick. What that means to have an unbreakable financial house is that no matter what happens in your life, no matter what comes your way, no matter what struggles, barriers, unexpected circumstances that you may face, you can handle it financially. And not only just handling things financially, but you can create the life that you truly want to live, like by design, and make the impact that you truly want to make for yourself, your family, your community, as far as you can imagine, to really reach your full potential. We all have gifts and talents that we were given to share. And if we're too busy focused on the wrong information about finances and not being able to create the life that you want to truly live, you're not focused on your gifts and talents. So we want to help you strengthen your financial house and make it truly unbreakable. So there are 6 building blocks that make up your financial house. Everybody has a financial house. Some people have a financial shack. Some people have a financial mansion, right? And a lot of people are in between. So the key is figuring out what you want your financial house to look like, and then what things do you need to do to get there. So these 6 building blocks I'm going to go over really quickly just to introduce them to you. And then Martin's going to deep dive on our amazing building your unbreakable finances in your life and business.
Yes. How we're going to talk about how to build your own bank. Chelsea's going to wrap up this part here, and I'm going to go into how do wealthy people utilize the strategies that we're talking about to build more capital, build the assets, build your own bank that you can leverage to buy real estate, to buy businesses that cash flow. How do you do all this stuff and do it in a tax-free way? So we're setting up the foundation so that I can talk deeper into that part.
All right, so let's go into what makes up your financial house. The first building block is cash flow. This is the money coming in and out of your financial house. The key here is to focus on increasing your cash flow, getting the right mindset, the right information to be able to expand, not contract. Okay. Debt management is building block number 2. This is understanding the difference between good and bad debt and how to use good debt to build your wealth. Building block number 3 is reserves. This is key, as many of us saw recently with the whole world shutting down. And a lot of people who made a lot of money, they were financially destitute because they were living paycheck to paycheck, no matter how much money they were making. So if they didn't have reserves, they didn't survive financially. If they did, they could make it through. And that's what we want to help you be able to get through anything that comes your way. Proper protection is building block number 4. This is having the right types and amounts of insurance, specifically life insurance. So key to ensure the financial survival of your financial house. Building block number 5, build wealth. We're going to deep dive on this one today. Everybody wants to build wealth now, in the future, and even beyond, longer than you're even here, which ties into building block number 6, which is build legacy. This is having the right documents in place so that all of your wishes are carried out while you're here. Let's say if you couldn't make financial decisions or medical decisions, you've got to designate somebody legally in writing to be able to have the right to do that. And also, when you're no longer here, what happens with your estate, your real estate, your belongings, all of the things that you've worked so hard to build and to pass on to the next generation? There's some steps and key things that you've got to have in place for that to actually happen. All right, so those are the 6 building blocks that make up your financial house. And I want you to think about, as you go through here, kind of identify where do you think that you might be in each of these building blocks, and what do you need to do to strengthen and get to the next level. And so Martin's going to go a lot deeper into building wealth and some strategies to do that. And then we'll show you how you can get more, how you can go to the next step to actually implement these things if you'd like our help with that.
Yeah, so thanks for being on here. Our core topic is one of the things we're passionate about doing is helping people understand their financial condition, financial situation better. Amen. So
thanks, Tammy.
so that they can build unbreakable finances. Because look, your finances impact so much in your life. The resources you have determine where you can live. And look. Let me tell you something. In reality, some of the situation happened in Afghanistan recently. Some people were able to get out privately. They didn't go through the government process. They were able to get out privately. Some people charter planes to go and do some of those things. Why? Because they have resources to be able to do it. I grew up in Liberia, West Africa. Liberia is right now the poorest country in the world. The last 2 years in a row was rated the poorest nation in the world. So I'm always interested in money and finances because I grew up in a country that's considered very poor. And so when I came to America, I want to understand how a lot of this stuff works. when we had civil war in Liberia and all of these kinds of different things. The people who escaped, the people who were fortunate to make it out, were people who had resources. Whenever things happen in society, the people with resources you give yourself the greatest chance to survive and to make it. It's always been that way. You look at through our history, people with resources, people with means, people with access to different things are the ones who end up surviving better, and their family surviving better. So what we're trying to do is give you information that can be helpful to you in the financial survival of your family, of your business, of your household, so that you can do better, because the better you do, the more you can help other people. And so the better I do financially, the better my household does financially. And I take care of my grandmother in Africa. We have to send her money every month. I just had to send her money this month so that she can be able to survive. So what are you going to say?
I was just going to say, and be an example, because it's so key for people to see what it looks like to be financially strong and successful. And that helps to spread, that information just by being the example.
So let's go to my piece that I've got for you guys here. So we'll dive into building wealth, building your own family bank, and how that works and helps you. Yeah.
And if you guys have any questions along the way, feel free to put them in the chat, and we'll do our best to get them answered today live.
Okay, so just give me 1 second here.
And if you haven't shared this out, please share this out if you think that people could benefit from this information.
Okay. So, look, I want to start with telling a story about when I came to America. I wanted to understand what wealthy people did. And for you guys who are watching on Instagram, you may not be able to see our slides. You can listen through. You can watch us on YouTube. There's a link in the bio where you can get signed up to watch and be able to see the screen, the things I'm sharing on screen. Actually, why is it not showing? Why is it not doing the screen share?
Well, there's a little bit of a delay, I think.
Hold on 1 second to make sure it's sharing. Okay, I see why. There we go.
Okay.
All right. No, that's not the video I want. Give us 1 second, guys. I don't know why it's showing this way today. Why don't you keep talking to them while I'm getting
so also in the chat, I would love to see what are some things that you guys would like to strengthen in your financial house. Like when it comes to your financial house, how strong of a financial house do you want? What are some of your financial goals, and what are some things that you're looking to learn to be able to strengthen your financial house? Put that in the chat, put it in the comments, and if you have any questions as well, put that in there.
Okay, so this is what I'm looking for. All right, so let's get rolling. What did these two wealthy men do? Cornelius Vanderbilt and Mayer Rothschild. This goes into how do you build long-term wealth, generational wealth. Generational wealth is like this big phrase that everybody likes to say, but very few people actually understand. How do you execute on it? What does that actually even mean? And how do you measure it? So what did these guys actually do to get into that financial position? So Vanderbilt was a guy who died in 1877, left $105 million. He left $1 million to Central University. They named it Vanderbilt University. That left $104 million to his heirs. 95 years later, fast forward, 95 years later, 120 Vanderbilt descendants, they got together for a family reunion. There wasn't a single millionaire among these people. What happened to this wealth? I thought this guy was building generational wealth. Here's a guy who left over $100+ million, and the wealth dissipated throughout the generations.
Wow.
Now, here's by contrast, there's a guy named Rothschild, right? He died in 1812, and he left not just money, he left a system. He left a family wealth management system in place. And he said, if you do these things, this is how the wealth will last for multiple generations. So it's not enough that you just leave money. You also have to leave knowledge and the right structures so that your family can continue to prosper, to prosper and do well. So one of the things he said was the family's wealth was to be kept together in one family bank. Next thing he said was the family could take a loan from the family bank, but the loan must be repaid. So he's like, dude, you're not just going to just borrow this money and then just take off. So he wanted to make sure that the family had resources together. They could loan, you could borrow money from the family bank. It could be to start businesses, it could be to do any different things you wanted to do, but you could use that and you repay the loan back to the family bank. And the third thing, which was very vital, says the family must meet once a year to share lessons learned. If not, they were out of the family bank. So recently, I just did this with some of my siblings. We got together, as I mentioned earlier, we take care of my grandmother in Africa. My grandmother's 93 years old. She 100% counts on us for her livelihood. If we do not send her money every month, she does not have food to eat. So she's completely dependent on us, right? There's no social services, there's none of that. So my grandmother has to have a live-in caretaker. She has to have money that gets sent for food, all these different things. Now, I got together with my siblings recently and we discussed financially what's some of the things I've been doing, what are my successful actions, what's some of the things I've helped put in place for them so that we can take some of those best practices and keep building. I don't want to be building my wealth and then my family members are not doing so well if I have knowledge that can be useful for them. So that was one of the things that Rothschild did. Now, one of the things here I'm going to share with you is financial concepts. Some of these concepts you're going to be in agreement with. You're going to be like, yes, that's true. I'm completely in agreement with that. Some of these other concepts are going to challenge your viewpoint. It's going to make you think, well, I thought one thing to be one way, but maybe it's actually different in reality. So some of this may be challenging to you, and some of this may be something you fully agree with. Well, as we go on, our idea is that you learn something, and then you want to do something more to help build your wealth, right? So the average, you always hear this phrase, it's not what you earn, it's what you keep. So the average American makes, let's say the average American makes $50,000 a year. Now, we're jumping into a concept of how your money is going to grow generationally. How you view and interact with money, how you use it, what you use it for. How that determines if you're going to end up being broke or if you're going to end up being wealthy for generations. And even if you don't have a massive amount of money to start with, there are things you can do that can actually put your next generation, yourself and next generation, to much better positions financially. All right, so let's say average person's earning $50,000 a year. If he saves all of that money, $50,000, every single penny he saves it, and he earns 5% per year on that money. After 40 years, so let's say this guy starts working at 25, he starts doing this process, or he starts doing this at 30. At age 70, that $50,000 a year that he's been earning would turn into $6 million after that 40 years, earning only 5%. Now, so here's what we call the wealth curve. I'll talk about this more as we go on. But this is that will be the value of this guy's wealth, right? Over the $50,000 a year, over his working lifetime, it would be $6 million. If he saved every penny of it and he got 5% interest rate on it, right? So this is not to get super in detail. This is just showing you this curve. How much you're actually going to earn in your lifetime. You're going to make and bring in a lot of money in your lifetime. What you do with that money and how you use it will determine what the outcome is for you. So now let's say this guy has to pay taxes on this money because we got to pay our taxes, right?
Man, come on.
So what you see there in that red part is the taxes. If this guy has to pay 28% in taxes, look how much the red part eats in his wealth.
I like the other way.
He ends up with far less money. So your largest expense, your largest bill are taxes. You end up with far less money because you have to pay taxes on it. Now, let's say this guy only saves 10% of his income, right? He pays taxes. He lives on 90% of the income, all that. He only saves 10% of his income. Look at that red part. That's all his taxes and lifestyle.
And that's the recommended amount you often hear.
Yeah.
10%.
People tell you to save 10% of your income. But look at the green part. You see how this green part, how it could have been much higher, but it fades away. And now he's only got a much, much smaller amount in that green part towards the end. What happened to all the wealth that he could have had? Well, it evaporated. It disappeared. It's not there. So this is the story of most people in America. Maybe you save 10% and maybe you don't. And then they go through the working lifetime and they arrive at something called retirement age, whatever that is. and they arrive at that age with too little money. Well, what happened? If you look back at those 30, 40 years behind them, the choices that they made with finances and the things they did impacted the outcome, the end result that they had. And why did they make those choices? Because of the information that they had. Most of the time, what I've realized is a lot of people are operating with incorrect information, or sometimes it's information that's just false about money, things you learned about money that just wasn't true. And the way you know if you're doing something that works is you look at your result. If you look at your result and you don't like your result on the subject of finances, is either you don't have enough education about it, or you have incorrect information that you're operating on, which leading you to results that's not ideal. It's not the result you ideally want. That's all that's happening. If you get correct information and you apply the correct information, good things will end up happening. You will get to where you want to be. All right, so we're going to talk a little bit about since we talked about how money works in terms of the decisions you make, it comes down to your mindset and how you view it. How do you view money? Do you view money like a spender? Do you view money like an investor? Do you view money like a banker and a wealth creator? How do you view and use money? You know, you can look at in movies you watch, they always say follow the money, because money tells a story. I could look at your money history. I don't even need to know you. I could look at how you behave with money. I could tell so many things about you. I could tell if you're disciplined or undisciplined. I could tell if you're likely to spend money. I can even tell if you're likely to have the same financial mistakes over and over and over again. Mm-hmm. It tells a story. So it starts with the mindset that you have, but actually your execution. How do you execute and operate on some of these things? All right. So here's how a spender views money. A spender is going to view money as a way to buy stuff, right? When I was growing up, I had false data that said, when you get money, spend it. Money's made to be spent. That's the data I used to operate on. Money's made to be spent. So when I got money, guess what I did? I spent it. When I came to America, anytime I made a little bit of money, guess what? I went to a nightclub. I bought bottle service. The first thing we would do every time I went to a new nightclub was, first of all, my first time visiting a nightclub, my rule was you have to buy bottle service. That was my rule. And the reason I did that was because if you buy bottle service the first time you go to that nightclub, the manager, the nightclub people always remember you. So the next time you want to get in, it's easy for you to get in.
My rule was always I have to have bottle service, but I'm never paying for it.
So she's a girl, she can get away with that. You can't walk in as a guy and pull that one off. So it was like, yeah, I looked at money as a way to buy stuff. So I was constantly spending money until I learned financial discipline. So every purchase costs the spender interest, because if I spend this money, I no longer have that money to earn interest for me. I've spent it, I've used it, I've consumed it, right? So if I borrow money, I have to pay interest. And if I pay cash for things, I give up earning interest. So every purchase, if I only view money like a spender does, and I either borrow money to buy stuff or I pay cash for things, it costs me interest. This may be something that might hit you a little bit differently to understand that even people who pay cash, it costs them interest. I'm gonna demonstrate that for you here. Even people who pay cash, it costs them interest. Somebody says, I remember them days, the bottle service days. Yeah, man.
How many of you spent your rent money on bottle service?
I had a buddy who would spend his rent money on bottle service. I had a buddy who made it rain in a nightclub with his rent money. He'd go into the nightclub and throw money in the air, and that was his rent money.
I had a roommate do that one time, and oh man.
Yeah. So let's look at something almost everybody has reality on, which is buying a car. So there's different ways you can buy a car, right? We're not going to get into the details of how do you go to a car dealership and buy a car, but we're talking about monetarily. How do you execute on this? So you can borrow the cash to buy the car. You can borrow the money to buy the car. You can pay cash for the car, or you can use something we call your private family banking, right? So I'm going to show you the differences and how the way you do things, the way you buy stuff, the way you handle your money and finances leads to building more wealth, or leads to you being financially compromised, not in a good financial position. So let's say I'm going to pay cash for my cars. I'm going to buy 11 cars over my lifetime, and they're all going to cost $30,000 each. And I'm going to pay cash for it, right? So over my lifetime, I'm going to spend $330,000 on car purchases. Just over those 11 cars, $30,000 each. That makes sense? $30,000, 11 times, 330 grand. Somebody says you must respect money no matter how much you make. Absolutely.
Mm-hmm.
Now, let's say I have to let's say I don't have 30 grand to pay cash for this car. I got to finance it, right? And it's going to cost me 5.5% interest every time I buy a car. And every 5 years, I'm going to buy a new car. So let's say that's the rule. Well, the borrower, because he borrows money, instead of paying $330,000, because there's interest on this, he will end up paying $378,000. That's that part in the red there, $378,000 that he would have paid total because he financed it. The cash buyer paid $330,000. The bank who finances it made $380,000. So the bank is actually coming out ahead of both of these people. Now, when you look at viewing money and making purchases and doing stuff you want to do, so let's say somebody wants to buy a car every 5 years and they're going to borrow the money to buy the car. So they're going to borrow the money and they're going to pay it off. So this red line is they get into debt, then they're going to pay it off. So every 5 years, this person ends up back at zero. They borrow money, they go into debt to purchase the car, and they go back to zero to pay it off. Now, let's look in the blue, the person who likes to pay cash. First, you got to save the money. Then you spend it on a car, and then you're back at zero. So if you look at it, the guy who borrows money ends up back at zero, and the person who pays cash ends up back at zero. So I got to first save the 30 grand and I pay cash for the car. I'm back at zero. I no longer have that 30 grand. I just bought a car with it. I go into debt 30 grand to buy the car. I spend the next 5 years paying it off. I pay it off and I'm back at zero. Do you understand that both of these people have not actually increased their wealth at all? The guy who paid cash never increased his wealth because he took the money that could have been earning him interest. He bought a car with it. So he's back at zero. The account went to zero. Let me know if that makes sense, what I'm saying. That resonates with you. And the guy who went into debt to buy the car, he pays it off and he's proud. I paid off my car. Guess what? He's also back at zero. Both of these guys end up back at zero. You pay cash, you end up back at zero. You finance it, you end up back at zero. Your wealth doesn't actually increase. So then how do you increase your wealth and buy cars at the same time? How do I do those things? That should be the questions people need to be asking. So Tammy says, makes sense. Awesome. Now, earlier we talked about how do you grow your wealth and stay on what we call the wealth curve. So this part here in green is somebody who their money was growing and compounding. The part in the red and blue is the people who end up back at zero every 5 years because they either save their money and pay cash or to go into debt and pay it off and get back at zero. However, there's a third way to look at money where your money can continue growing, compounding, and you can actually use it to buy things you want to buy assets, to buy cars, to buy businesses, all these kinds of different things. And before we get into that part, I want to talk about how an investor views money, right? And now Chelsea mentioned in the beginning, we've held securities and investment advisory licenses, right? We've had a Series 6, Series 63, Series 65. That can help people invest money in the markets. But over time, we realize a lot of people don't understand what they're doing when they're investing in the market. So what happens is when people try to invest, they're hoping the investment goes up. And they expose themselves to risks they don't understand. And when they make gains, depending on what type of investments they have, anytime they make gains, it costs them taxes. It's called capital gains tax in America. And depending on how often you buy or sell certain assets can determine if you're going to pay long-term capital gains or short-term capital gains on your growth. But one thing people don't fully understand is the risk that involves certain places they put their money. So I'm going to give you an example here. So let's say a person has $100,000 and they invest. And their investment goes up by 10% with the first year, right? So like, hey, that's fantastic. It went up by 10%. And then the second year, it goes down by 10%. So up 10%, down 10%. Is that person at the $100,000 they started with? So I'm going to give you that scenario. I want you guys to drop in the comments if you think at where this started with. You had $100,000 that you started with. First year, you made 10%. Next year, you lost 10%. Are you back to the 100,000 you start off with? So what do you guys think about that? Do you think the person is back to where they started? Drop in the comments and let me know what you think. Up 10%, down 10%.
They have a little bit of a delay too.
Yeah, so you guys got a little bit of delay on there. So Felicia says loss. Yes, they're at a loss. If you made 10% and you went down 10%, you are not back to where you started. Yes, somebody said, Richie says they're down 1,000. Yes, you are down. You're down to $99,000. You understand? So a lot of times financial things will use percentages, and whenever you have money that's fluctuating up and down, you have to understand what is the actual dollar amount that's there, not just the up and down, right? Somebody said only if you sell. Even if you don't sell, your account statement will still read $99,000. If you have $100,000 in an investment and it went up, 10% and it went down 10%, your account balance will say $99,000, even if you don't sell. It means if you do withdraw money from that account, you will not get the 100, you will get 99. So the loss is still on paper, but it's still a loss. Just like the gain was on paper because you didn't actually get that money yet, but it was still a gain. So the only time it actually materializes is when you pull the money out, but actually the account balance will still show that actual amount. Yes, DeMarco says back where it started. So she says worse. Hila says worse. Awesome. So let me explain to you why that happens. Anytime you lose money, it takes more money to get back to even. Every dollar you lose, you not only lose that dollar, you lose what that dollar would have earned for you had you not lost it in the first place. This is $100, right? If I lose this $100, I not only lose what this $100 would have earned for me. I not only lose this $100, I lose what it would have earned for me. Let's say this $100 would have earned $20 for me over the next couple of years, right? She's trying to see how much cash I got. She's offers her money. Mm-hmm. So let's say I got this $100. I got this $100. And over the next few years, this $100 would have earned me this 120. But I lost this 100. Not only did I lose this 100, I lost the future 20 it would have gotten for me. So in reality, I lost this future money because I lost this 100 in the first place. So if you look at money as something that will go and bring more money to you, you not only lose that money, every dollar you lose is not just about that dollar, it's about what that dollar would have earned for you. So over here, if you lose 20%, you got to make 20%, 25% gain just to get your money back. If you lose 40%, like people did in 2008, you got to get 67% gain just to get back to even because you went backwards. The idea is you want to grow your wealth without going backwards. That's part of how you win the game. So the third way you can view money is as a banker. So how does a banker look at money? And I'm not talking about looking at money like the people just work at the bank. I'm talking about if you own a bank. How would you look at money? Those deposits come into you. A bank is a financial institution that takes in deposits and makes loans. The very basics of it is that definition. So if you operate with that definition, you're like the bank makes money by lending money out. So when they receive money from as deposits, they're looking at how do I lend this out to make more money? Every purchase is an opportunity to gain. How do I keep my money working and buy assets at the same time? That's how you stay on something we call the wealth curve. So if you keep your money working continually, it's something you earn something called compound interest. Albert Einstein said it was the most powerful force in the universe. What that means is your interest earns more interest, earns more interest. This $100 earned $20 in interest. This $120 goes to earn more interest. Then the next year, the $140 goes to earn more interest. You see, it's building on top of itself. It's compounding. Think of it like a snowball that keeps getting bigger and bigger and bigger. You never want to interrupt a massive growing pool of money. You want it to keep growing bigger and bigger and bigger, right? So you want to stay on something called a wealth curve. Wealth curve means I have my money continually working for me without stopping. and I can leverage that money to buy assets. So I can have my money working continually, growing. And if I want to buy a car, I can leverage that pool of money to buy a car without interrupting that money. That money continues to grow, right? I'm going to show you how you do that. The other thing is, if I want to buy a business, if I want to buy real estate, how do I keep my money working in one location, leverage it to then use it to buy a second asset? Ideally, an asset that's going to cash flow. So I have my money working in my family bank, and I leverage it to buy real estate. My money in my family bank keeps growing, and I still own a real estate properties that cash flow. See, I leverage one asset to buy a secondary asset that cash flows. All right, so yeah, somebody says, President Richard Nixon cut the gold from the dollar in 1971. Absolutely true. Your money is worth less and less and less. And by the way, they printed 25% of the money. This paper money here that exists now did not exist a few years ago. They printed a lot of money. When they print more money, this money becomes worth less and less. That's why your money has to continually to grow, because your government has the ability to print money. Your money's not backed by gold anymore. It's just backed by the faith in the United States government. This is not even money. This is debt. This is actually debt. I won't get into that, but that's what this is. Okay. So you want to have your money growing and stay on the wealth curve for the rest of your life. It says Federal Reserve note. Note means a debt. That's why people say card note. Federal Reserve note is a debt. It's a debt thing. But people don't understand that. This is debt. Every purchase costs us interest. You either pay up interest or you give up interest, right? So when you're building your family bank, what you want to do is you want to create a pool of money. You want to put that money to work, earning compound interest, and then you want to use that pool of money as collateral when you need cash to do stuff with. So I accumulate my money inside of a financial vehicle, and then with your financial bank, you're not going to go and put a brick and mortar bank on the corner. You're going to use a financial vehicle as your bank. So we're going to talk about what's the ideal financial vehicle to use. So does all this stuff make sense? Somebody says it's getting great info. Thanks guys. Appreciate all the feedback. Before we get to that part and the financial vehicle you use to build your family bank with, I want to teach you this concept because it's vital in understanding that part. If our money was earning 4%, so I want you guys to answer this question back to me. If our money was earning 4%, so I got my money somewhere is earning me 4%, would it make sense for me to borrow money at 6%? If my money's earning me 4%, I got this $100 over here, it's earning me 4%. Will it make sense for me to borrow money at 6%? What do you guys think? Would it make sense to do that? Based on what you understand to be true about money and finances.
What you think, guys?
What do you think? Drop me in a comment. Do you think it makes sense? Would it make sense? Yes or no? If my money's earning 4%, would it make sense for me to borrow money at 6%? What do you guys think?
It's a little overfull there.
And Marco.
Unloading?
No, it's okay.
Pile of cash?
She says the wallet is full.
Put it over here.
So somebody says no, because somewhere is making money on your money. Somebody says yes. So would it make sense to borrow at 6%? Somebody says yes. Some people said no. So let me show you an example on this. So let's say I go to buy a car. Car's $30,000, right? And they tell me, hey, I think we can finance this car for you. It's going to be a 5-year period. You can finance this car. We're going to charge you 6%. Your payment's going to be $580 per month on this car. Now you're like, I have this account paying me 4%. I got $30,000 in this account paying me 4%. Now, what a lot of people will do will look at and say the 6% is higher. I got the cash, so I should pay cash for this car. Actually, so let's look at the math behind it. Over that 5-year period, I would have paid $34,799. That's the total I would have paid for the car. I would have paid 6% interest over a 5-year period, $30,000. However, if my money's earning me 4%, at the end of those 5 years, my account would be at $36,630. In this case, it would have made sense for me to borrow the money, because I would actually end up with a couple $1,000s more had I borrowed the money, kept my money growing for me instead of paying cash for the car. You guys see that? So sometimes things you're told may seem to make sense, but it doesn't make sense until you look at numbers. Why is that? Why is it that even though my money's earning me 4%, it ends up with a higher dollar amount than the interest, than what I would have paid total in interest at 6%? Why did it make sense for me to borrow money at 6%, even though my money was earning me 4%? For a very simple reason. When you're paying down debt, you're reducing the debt each year, so that debt eventually goes down to zero. When you're earning compound interest, your money's building on top of itself each year, so that money's getting larger and larger each year. So the 4% I earn on my money will end up making me more than the 6% I would have paid on this debt. So I actually end up with more money. You guys see that? Yeah, Felicia says compound. It's building. Mm-hmm. So that's what you got to understand. The compound interest of your money, extremely vital. The compound interest of your money, understanding compound interest. And I want to explain to you this because let me go to this section.
She says, "This is why I need you guys in my life. Adopt me."
Yeah. So I'm gonna the money's compound exactly. This is something that may blow your mind, but billionaires do not pay cash for their properties. They don't pay cash for their houses.
Boom.
So billionaires don't pay cash for the house, right? Even though they can afford to pay cash, why don't they pay cash? They don't do it because they rather have their money working for them than paying on the debt. Doesn't mean now we're talking about, if you got credit card debt and you got bad debt, then you pay on that. But billionaires finance their properties. So Mark Zuckerberg refinanced his house a few years ago, $6 million property. Mark Zuckerberg is a multi-billionaire. It would take him less time to write a check for $6 million than it would take to sign the documents to refinance his property.
Those are a lot of documents.
It's a lot of documents you got to sign. So why did Mark Zuckerberg refinance his house? Because the cost to him was less. It made sense for him to use somebody else's money on his house than for him to use his own money to buy the property. So Mark Zuckerberg has his money growing and compounding. He's like, I'm not going to lose my money. If somebody's going to lend me money to buy it, I know I can earn more on mine than what I'm going to pay in interest. I will borrow money every time. A lot of people say that. They're like, oh, I want to get so rich, I'll pay cash for my house. Anytime I hear that, all it tells me is the person hasn't fully looked at it completely, or the person doesn't they may not fully know or be aware of how they can have their money compounding for them in another location and use it and to buy the properties they want to buy. So here's another guy, Warren Buffett. Warren Buffett explains why his mortgage borrowing strategy. Everybody knows Warren Buffett has his primary residence in Omaha, all that, they know all of that. But they don't understand that Warren Buffett in 1971 took out a second mortgage to buy a second house, even though he could have easily paid cash for the property. He explained, he's like, look, my money's working in another location. I don't want to interrupt that. I don't want to get off the wealth curve. So I'm going to use somebody else's money. I'm going to use the bank's money and buy the property. Beyonce and Jay-Z, this is in the Wall Street Journal. Beyonce and Jay-Z, why do Beyonce and Jay-Z have a massive mortgage? Why do these people take on debt when they can pay cash? Let me tell you, rich people don't always pay cash for things. Even if it seems like they're paying cash, they're not paying cash. It just may look that way to the ordinary person, right? People aren't paying cash for their stuff. So it says, what Beyonce and these billionaires have in common? Massive mortgages. So if billionaires who have cash can afford to pay cash for these properties, they don't. You understand? You got to do what wealthy people do. They use leverage. They may have their money working in one location. They don't want to interrupt that, so they use leverage. Leverage means you can use your capital in more than one place at the same time. So let's go back to this here.
DeMarco says, I'm so excited to see the vehicles to put this money.
All right, so display settings here. Yeah, so we're going to get to that here in just 1 second. Okay, back to the phone. Great.
Mm-hmm.
So I'm going to go through some of these parts. The way we use, what we use to build our family bank is financial instruments with guarantees, right? And it's very simple when what we're using for some of these. One, the financial vehicles we're using have no risk involved with the money. I don't want to lose my money and have setbacks. We already saw what happens when you have a loss, so you don't want to do that. I want guarantees. I want to make sure I get guarantees on my money. I don't want penalties on my money, meaning that I can access my money without penalties. Liquidity, use, and control. I want to get access to money whenever I need it. So let's say I want to buy a real estate deal and I need the money quickly and to take advantage of that real estate deal. I can leverage that money in a matter of days, get access to the money, and go and take advantage of the real estate deal. I want to protect it from creditors. If I'm buying real estate, if I'm buying assets, I have tenants in a property. What if the tenants sue me? I don't want them to come after me and my money. I want to have my assets protected. And I want to use leverage. I want to be able to have my money working in one location and leverage it, borrow against it to put money in another location, right? I want the money to grow without any taxes. And I want to access the money when tax-free when I need money. And I also don't want to, I want the money to be able to use as collateral for my loans, which means I can keep my money working and borrow against it. So lots of other things I won't get into. Wealth transfer. I want this money to transfer to my family or my heirs tax-free. These are all the kinds of things I want in a vehicle that would be ideal for a family bank. So what we use for our family bank and what we talk to our clients about, and we have a lot of our clients use, is we use a certain type of life insurance called high cash value life insurance policies. The permanent life insurance policies that are also used by banks. There's life insurance policies that banks use. It's called bank-owned life insurance. So banks, you can look all these up. Banks, Bank of America, Chase, Wells Fargo, all of these companies have hundreds of billions of dollars inside of life insurance policies. And as an asset class is recommended as used by the FDIC for banks. It's called Tier 1 capital, means that it's safe. There's a safe place for banks to put their money. Why? Because of all the things we listed and talked about a little earlier. So what we do is we customize life insurance policies and use it for its banking functions. So I can typically earn a higher interest rate than I can in my life insurance policy than I can at the bank. So I store money inside of a life insurance policy, build up the capital, and then leverage it to buy real estate, buy other assets, and do different things with it. It gives me liquidity, it gives me safety, I can get guaranteed growth, I can get protection from taxes, protection from lawsuits, different things like that, because it's stored inside of a life insurance policy. And there's certain features and benefits and protections that I have that comes along with that. So basically, I would put money inside of my family bank, my life insurance policy, build that up, leverage it to buy real estate. I can leverage it to pay down debt. I can leverage it to buy cars. I can do whatever I want with the money. And when I take a loan against my life insurance policy, it does not affect my credit. It does not show up on your credit report. And you don't have to pay any taxes on it because it's a loan. So you get that money coming into you without having to pay any taxes on it. And additionally, if I died, let's say I took a loan and I died the next year and the loan was still outstanding, I never paid that loan back, because it is a life insurance policy, there is a death benefit that will pay off the loan and the rest of the money will go to my family tax-free. So I was able to use it to buy real estate, able to use it to buy vehicles, and I still leave a tax-free death benefit to my family. And if I got sick, critically sick or hurt, I can still access that money while I'm still living to pay for my living expenses and stuff like that. So here's a quick example we put together. This was an example of somebody in their 40s. They were putting $1,000 a month away into a plan like this. So they're saving 10, 12 grand a year. They did that till age 70. At age 70, they have $1.3 million of cash built up in their policy. They can use this money for any purpose. They can use it for, I know it's kind of small on the screen there, but it's $1,339,000 is projected cash value inside of the policy. And their death benefit is $1.6 million. If they died at age 70, they will leave their family $1.6 million. If they're alive at age 70, they have $1.3 million that they can use for retirement income. They can use to buy more real estate. They can do all kinds of different things with it. Then, if this person wants to use this policy sooner, I mean, you can start using it. Some policies you can use within the first year, some policies you can use after year one. But in this example, this person had this policy for after 7 years. They can take $100,000 loan against the policy and use that to buy real estate. So let's say I got an apartment building I want to buy. I've got this money in my policy earning me compound interest. I got money in my policy. I see this apartment deal I want to buy. I go to the policy, leverage it, and go and buy the apartment building. So, hey, Rain, it's 6billionblocks.com/strategy. So she's talking about how if you want a free strategy call. So we're going to talk about that here in a second. So here's a visual on how you can look at this. We like the combination of life insurance and real estate. We use life insurance for its banking function. We store money inside of properly designed and properly funded high cash value life insurance policy. Right, so we fund money into that. While the money is growing and compounding, we leverage it to buy real estate with it. Ideally, real estate that cash flows. There's Chelsea and I are looking for assisted living properties because assisted living properties have very strong cash flow, and so we have that piece of it. And then multifamily, where you have apartment buildings, all of that provides great cash flow. Self-storage provides great cash flow. I actually personally like, we haven't done this part yet, but I really like mobile homes. For whatever reason, I really like mobile homes. I think affordable housing is very important in America. And so mobile homes, all of these things produce cash flow. So you can use this to build your own family bank, leverage it to buy real estate. And if you have real estate that cash flows, that can pay for your lifestyle. That's what people call passive income because it's coming to you without you having to go out there every day and earn it. So if you have sufficient passive income, you can become financially free. Well, how do you build those steps? You got to store your money somewhere, then you got to leverage it to buy real estate, and you can do that multiple times. And so once you do these kinds of different things, it puts you in a position to be financially strong and financially solvent, to where you can have cash flow coming into you without you having to go out and earn it every single day and every single week. So why don't you talk about that?
So if you would like to find out how you can implement these strategies into your financial house, if you'd like to talk with us or a member of our team to look at your financial house and see how you could implement this strategy, we are offering a free strategy call that you can apply for. You can go to 6buildingblocks.com/strategy, and we would be happy to help you look at these 6 areas of your financial house and how you could use a strategy like this to build more wealth, to protect that wealth, and to make sure it lasts as long as you do, even longer, so that you can truly create that life that you want to live and make the impact that you want to make.
So if there's any questions, feel free to drop them in here. We'll answer before we wrap up here.
So there was one question. Felicia says, what is the best investment for someone who has $10K in cash?
It will depend on a couple of factors, Felicia. It could be like when you might need that. Are you putting that money away for long term where you're not going to need it right away? Or are you looking for something short term? Right. So we can talk to you and figure out where things are. You can talk to us, somebody on our team that will help you identify what's the best thing for you to do. Sometimes the money, I tell people this all the time. Sometimes the money is not meant to go into a financial investment. Sometimes it is meant to go into your business. Because like sometimes a person will have a business and they're like, I have a good business. I can grow this business. I can make money with this business. But they're like, but I need to market the business. But they got this money sitting aside in a retirement account or for retirement. And I'm like, hey, if you think you can earn more by putting this money into your business, then that may be the ideal thing to do. So long term, we can talk to you specifically about it because I don't know enough about your financial position. I don't know what your income is. I don't know how much money you have in reserves. Things like that. So those are some of the things that we talk to people about, and then we give them a recommendation as to what is the ideal thing for them to do. DeMarco says you guys are terrific. I appreciate you, man.
And thank you. And that's what we go through in the strategy call. We go through each of those areas so that we can identify where you're at, what things that you need to do to be able to reach your financial goals in the most efficient way, and also avoiding any risks along the way that you may not even know that you face. So some of these strategies, when people are looking at like, what's the best investment or where can I put my money? It's not just about the investment, like Martin is saying. It's about making sure you have the foundation of all of these pieces in place so that when you build and focus on building more wealth, that it does last. Your financial house is not going to collapse because you have all of these areas strong and unbreakable. So
let me tell you guys something. And then, oh, by the way, to get a
we love you too.
Free digital copy of the book, you go to letsfightaboutmoney.com/ebook. You can download a free digital copy of our book there. When I came to America, I really wanted to understand about money. It's like, look, I wanted to know about money. I didn't have any problems with like, hey, do you know about money? I used to ask people that all the time. Hey, do you know about money? Can you teach me about money? What do you know about money? And then finally, I started to find correct information. And it was a guy who knew rich people. People gave me all kinds of information and they were not rich, or they were not on their way to becoming rich. And I'm like, shit, dude, it's like your information is not going to help me so much. And then I met a financial advisor. And the first question I asked him is, do you know rich people? Because he's like, oh yeah, I got a financial business. And the guy was very successful already. He did real estate and he did financial services. And so I said, man, do you know rich people? Basa G, what's up, guys? Wealth Builder 205. So I'm like, do you know rich people? He's like, yeah. I'm like, what did they do with their money? How did they make it? Where did they keep it? What did they do with it? So he was the guy who showed me these concepts. That was over 15 years ago. And so around that time. So this guy shared these concepts with me. And then I started to learn that and apply it for myself. And it seemed some of the things you were saying seemed counterintuitive. But there's a saying, just because everybody's doing something doesn't mean it's the right thing for you to do. Just because every dog is barking at the truck doesn't mean that's the right truck for you to be barking at. Most people in middle America get incorrect advice. And unfortunately, the advice is for people who either they are at or plan to stay at under $70,000 a year. If that's your goal and that's your only aspirations, you're going to be $70,000 a year for your household or less. Most of the information you find out in the media, that's for you. That's who it's for, because that's the average person in America. The average income in America is under 50 grand. So as a result, the information that's catered to you is that. But if you aspire to be more and you aspire to earn more and do more and create more wealth generationally, then you have to use different information. That's not for that. It's for building wealth with. And so is why we use and talk about some of these strategies. Look, I have millions of dollars in life insurance. I'm a high income earner. I have a business, yet I have a lot of life insurance. Why? Because life insurance to me isn't about dying. It's about cash flow. How do I make sure my family has enough cash flow? If I get critically or chronically sick, what if tomorrow I get diagnosed with cancer and I can't run my business this way like I'm doing now? How do I ensure I have sufficient cash flow? Well, one of my life insurance policies can write me a check for $1 million. Boom, $1 million tax-free. I will use that to then create even more cash flow. I will use that to buy more real estate. So you understand, this is how you have to start looking at building wealth in your finances, right? So if you want a free strategy call with us, you can apply for a strategy call here. You can go here, 6buildingblocks.com/strategy. For you guys watching Instagram, it's the number 6, so 6buildingblocks.com/strategy. And we will speak with you. We'll talk with you, apply for a strategy call, and we'll get together with you. And we'll help you understand your finances better. And we'll show you how you can customize your family bank with actual numbers and say, if you're putting this much away, here's how much you'll have. Here's how much you can leverage to buy real estate. Here's some private real estate deals that's coming up, stuff like that we'll talk about doing. So anyway, good chatting with you guys. Anything else you want to say before we wrap up here?
Thank you so much for joining us. We really, really appreciate you spending some of your day with us. And we hope that this information has been valuable and helpful and enjoyable to you. And we look forward to talking to you further and helping you with strengthening your financial house. If you have any further questions, feel free to reach out. And we look forward to seeing you soon.
Yeah, share this video with people you know. There's been people we've done business with. They're like, dude, somebody shared your video with me, and I love the things you said. So share this with somebody you know, and we'll, if we help them, we'll actually send you like a thank you gift or something. So share the video out. Let people, if you think this concept's great, share with people you know, and we'll talk to you soon. Thanks, guys. Have a great rest of your day.
Bye.